You run a profitable business with strong cash flow. You have healthy reserves and a pristine credit score. But when you apply for a traditional mortgage, you get shut out. The traditional mortgage industry isn't built for entrepreneurs. It's an assembly line designed exclusively to process the clean, predictable tax returns of W-2 wage earners. If you own a business, you rely on legal deductions, writing off equipment, travel, and home offices to lower your taxable income. It's smart business, but it actively destroys your ability to buy a home. The roadblock comes down to a single metric, the debt-to-income, or DTI, ratio. This is the percentage of your gross monthly income that goes toward paying your monthly debts. For a W-2 employee, conventional banks calculate DTI using their gross salary. But for the self-employed, underwriters calculate DTI using your net income, the number left over after all your deductions, completely ignoring the actual cash flowing through your accounts. Your ledger shows $150,000 in gross deposits, but your tax return shows a net income of only $40,000. Because underwriters use that lower figure, your debt ratio spikes and your application is rejected. Your actual liquidity is ignored. The system measures your tax liability, not your financial health. This forces a harsh choice: artificially inflate your tax bill to qualify for a loan, or keep your capital and rent. There is a structural alternative designed to bypass this trap. It's called a non-qualified mortgage, or non-QM loan. A non-QM loan evaluates your ability to repay based on actual liquidity and revenue metrics. It removes tax returns from the equation entirely. These are not the reckless no-doc or subprime loans from the 2008 financial crisis. You cannot simply state an income and get a house. Modern non-QM lenders demand rigorous proof. They require high credit scores and substantial down payments. If you have the capital, you can stop fighting conventional underwriters. We are going to evaluate the 3 primary non-QM paths so you can find the exact loan built for your business structure. The first option in our evaluation framework is the 1099-only mortgage. This decision tree shows exactly who this loan serves. Freelancers, consultants, and independent contractors fall into this specific branch. The inputs are strict but simple. Provide 1 to 2 years of IRS 1099 forms and maintain a 620 minimum credit score. No tax returns required. Instead of deducting your business expenses, the underwriter calculates your qualifying income based entirely on your gross 1099 earnings. This approach accelerates the underwriting timeline by reducing the paperwork. More importantly, it fully protects your tax write-offs, allowing you to keep your deductions intact. But there is a trade-off. Unlike a conventional loan that might allow 3% down, a 1099 loan typically requires a 10 to 20% down payment, tying up more of your liquid capital. The 1099-only loan is the optimal tool for independent workers whose gross revenue is steady, but whose net income is mathematically destroyed by legal deductions. The second branch of the framework is the bank statement loan. Going back to our diagram, this path is engineered for LLC owners and high cash flow entrepreneurs. The node expands to show 12 to 24 months of bank statements, splitting into personal and business columns. Personal deposits receive full credit, while business deposits face a 50% reduction. That business account penalty exists because underwriters automatically assume a 50% operating expense ratio. They have to assume it costs money to run your company, so they cut your gross deposits in half to estimate realistic profit margins. Even with that 50% haircut, this calculation almost always reveals higher true cash flow than your heavily suppressed tax returns, unlocking massive borrowing power. The vulnerability here is your actual profit margin. If you run a high-revenue business with very tight margins, meaning operating expenses are well above 50%, you will struggle to show enough qualifying income. This loan is the ultimate leverage mechanism for capital-heavy entrepreneurs, provided your profit margins can actually survive the lender's expense assumptions. The final branch is the debt service coverage ratio, or DSCR, loan. This branch targets real estate investors needing to decouple personal income from portfolio growth. A DSCR loan evaluates the asset, requiring proof that fair market rent covers the mortgage. If rental income matches or exceeds the payment, you hit a ratio of 1.0 or higher. This completely removes your personal income and your W-2s from the equation. Because of this, DSCR loans are legally restricted to investment properties only. You cannot use this to buy your primary residence. DSCR loans are the definitive scaling tool for investors. They allow you to expand your portfolio infinitely without ever maxing out your personal debt-to-income ratio. Bypassing conventional guidelines set by the Consumer Financial Protection Bureau comes with inherent risks. When the lender takes on the liability of ignoring your tax returns, you pay for it. That flexibility exacts a heavy premium.
To offset their perceived risk, lenders enforce 3 direct financial penalties: higher interest rates, upfront discount points, and massive down payments. You also absorb an operational penalty. Non-QM loans require complex, manual underwriting, which routinely jeopardizes standard 30-day closing deadlines. In the non-QM market, flexibility is highly expensive. You are paying a direct financial premium for the privilege of ignoring your tax returns. Because of these costs, a non-QM loan should be viewed as a temporary bridge, not a 30-year commitment. This scorecard maps the strategy. Freelancers utilize the 1099 loan. LLC owners rely on the bank statement loan. Real estate investors scale with DSCR. All require significant down payments and alternative income proof. The optimal exit strategy is simple. Use the non-QM loan to secure the asset today based on your cash flow. Then, 12 to 24 months later, refinance into a conventional loan once your tax strategy aligns. You must avoid these products if you are a W-2 employee with straightforward taxes, or if you are self-employed with less than 10% in liquid cash reserves. If you lack capital, optimizing next year's tax returns to qualify for a conventional loan is mathematically superior. But if you have the cash, a non-QM mortgage is the ultimate tool to permanently decouple your home ownership goals from your tax liabilities.